And I sat there and watched it peak up out at about 100% and then very gradually go all the way back
But if you're
down.
reminded every day on the ticker tape and you're watching it every day, I don't look at the value of my property every day. I'd go nuts.
Being a do-it-yourselfer in stocks, it's so easy. You can open an account in 5 minutes, fund it with $5,000.
Hi, this is Bill Mulkey. I'm the president of TR Wealth Management. Today, I have a super guest, Duane Lappinga. He's my CFO and asset manager, looking over all of our real estate acquisitions and dispositions and talking to our investors. And Duane has a very diverse background, and I want to hear from him on this. I think he's got a lot to share, and we're going to talk about today how does commercial real estate compare to the stock market as an investment. So, Duane, it's my pleasure to have you. And I wanted to introduce you and go ahead and take it from here. I want to know more about you. Tell us your story.
Okay, thanks, Bill. As far as my career, I'll be very brief because we want to focus on the investing stuff. So I was originally a mechanical engineer by trade and then became an energy engineer. And I like the financial aspect of energy engineering, that you're trying to make buildings more profitable. And at the same time, you're helping the planet. So it's a win that really appealed to me, and crunching the numbers. And of course, I was working for real estate companies, so I was getting more and more interested in real estate as an investment. And so my first stab at investing was right in 2000, when tech stocks were going to the moon. And that was my first experience investing and my first mistake. But I would tell anybody about investing: if you haven't made a mistake or lost money, then you haven't really gotten started, because that's how you learn. Now,
I agree with
thankfully,
that. I agree with that, Duane. What was the mistake? Could I go over that first? And if you're prepared to talk about that, or
oh
can
yeah,
you peel back the
no,
onion a little bit?
no pride here. So I bought a mutual fund that was technology focused. Great move in 2000. It went up 90%. And then I sat there and held it and watched it peak up out at about 100% and then very gradually go all the way back down below what I originally paid for it. And I never sold, because I had my first book that I read about investing was by Warren Buffett, and his hold period is forever. What I didn't get was, yeah, he wasn't investing in tech stocks. And you can get all kinds of advice and misapply it. And I learned a lesson. Yeah, I like to buy and hold, but sometimes you need to understand that you need to take profits. And so that technology crash in tech stocks was very painful to me, but I learned. And at least I diversified into a few different investments, and I saw that I needed to get out, and I recouped some of my money. And then I actually kind of retired from stock market investing for a few years after being bruised like that. And my next lesson was my 401k, which was all in the stock market. 2008 happened, and for whatever reason, I decided to hold. And that was the right reason. Every dollar that I lost on paper during 2008 came back within about 2 or 3 years. And then it went on upward and upward from there.
So you had a strategy. I was going to ask you, did you have a strategy? And yes, you did. Engineers usually have a plan. They're taught that way, I'm sure. And that's what's good. Us people that don't learn very quickly that you just get lost. So that's really good. So what's the primary difference between stocks and real estate? And I know I knew that techs were more volatile. All their earnings and all that stuff didn't make as much sense, price earnings ratios or whatever. Tell me a little bit more about this.
If you don't mind, I'm going to go a little bit further into my
Sure.
story, because that was really
Sure.
just the very beginning. Well, all
Sure.
I've really done at that point in my investing career is learn two lessons: one, losing money, and the other, coming out ahead by not selling. And you said engineers want to follow rules or whatever. And after a while, I started to learn, yeah, you read books and you get advice, but you need to think for yourself when you're investing. Only you can make decisions about your own investments. You can be a sponge, take in all the information from everywhere, but then you have to filter it and decide what works for you. And so my next real big experience with the stock market was my mom and dad were getting older, and they had literally $1 million sitting in CDs, savings accounts, etc. And it was making less than 1% at that time. This is circa 2012. And I did not want to manage my parents' money, but it was making me sick that it was sitting there doing nothing. And after a lot of family, I wouldn't say conflict, we weren't screaming at each other, but there's a lot of tension about what to do with that. And I didn't want to manage it. Somehow I ended up managing all their money. And I was honestly the responsibility, I was scared to death, but I implemented the most conservative strategy that I could possibly contemplate and put like half the money in CDs, a quarter of the money in mutual funds, and then a quarter of the money in individual stocks. And it was weighted towards dividend paying stocks. I put small amounts in companies, the big names like Microsoft and Apple, honestly thinking that these have grown an awful lot. I don't know if they're going to go up more. And maybe it was God reaching down or something, because my mom was a very God fearing woman, but it seemed like everything I bought for her just went to the moon. I bought John Deere, it went to the moon. I bought Apple, it went to the moon. And she was, after like 5 years, some of these names, she was up 400% in those individual names. And that really carried her portfolio to where when she passed away last year, that $1 million had become $1.8 million. And we only put half the money into stocks. So that was a big success story. And my big lesson out of that was, hey, buy and hold and being conservative is actually quite good. And I was more careful with her money. I wasn't trying to make 100% in 5 minutes. And with my own investments, I've often been too aggressive because I really want to take risk on here and do very well. And then I'd end up seeing bad results, selling out or whatever, and not do as well. So that was my second lesson in stock investing. And then I went back in, that kind of buoyed my spirits, and I got back involved with buying stocks on my own behalf, using those lessons learned. And I had one experience coming out of COVID where I put a lot of money into the rebound coming out of COVID and actually made enough profits to buy my daughter a brand new car. So that was pretty
Oh,
cool.
this is a great story. It's funny that you applied that in strategy. John Deere's and the ones you were picking, Microsoft, maybe not so much, but did you do a lot of research and analyzing, or because the stock market is very fluid? How did you feel you got advantage of it, or your strategy just worked over time, or inflationary? What kind of helped you out
So
during
that's
that time?
another, yeah, that's another lesson learned is, believe it or not, you really don't want to overanalyze it. You can stay up all night researching one stock and think you've come to a great conclusion, put a bunch of money in that and have it drop immediately after you buy. And then it really deflates you emotionally. And I would say much better to put put your money in some name brands or find some stock recommendations from reputable sources,
Hmm.
and then diversify your money in some quality stuff. Everybody knows the quality names. So the real discipline is not finding those obscure stocks. The real discipline is don't put all your money in one. Even if you love Apple, you're going to put maybe maximum 5% of your portfolio in Apple, because we never know what's going to happen. And my mom was laughing. I put money in waste management, most boring stock I could think of. And in a year, it was up 100%. My mom and I had a good laugh about that. So,
Wow.
Microsoft at that time, I thought Microsoft is an old technology company. What do they do besides make Windows, right? So I put her money in it. And right after they got into cloud computing, and that stock went up like 300% or something. So it was amazing. I don't know. I think my mom had been very thrifty her whole life, and I think she deserved a few breaks. So it was quite the experience. And then, of course, being able to buy my daughter a brand new car. It was a Toyota Corolla. It wasn't a Ferrari, but I had coming out of COVID, I managed to, I think, have profits of $30,000 or something. I doubled my portfolio. The bummer was I think I only had $40,000 to play with. And after that rebound, I think I had 80,000 and I took some of it and bought her that new car. Um,
I have a question for you. And what was the period of time? Maybe I wasn't following carefully that you almost doubled or did double your portfolio basically. Was it like a short period of time, a long period of time? I forgot
uh,
exactly how long you said.
sure, 2020. That's when COVID-19 hit. Same time period that we bought our building in Long Beach. I'm sure you remember that.
I'm such a real estate guy. I always want to put in these investments, but you can't get weighted into one thing. I got over into real estate way too much. And then when real estate doesn't do so good or falls out of favor, I saw people doing very well with stocks. It sounds like you know a hell of a lot more than I did. The one thing I did right is I treated them like they were Las Vegas. Go there and easy money, quick money, maybe a little bit like when you first started. I want to make quick money fast because that's exciting to me. And I love trading. I love trading real estate, but I'm no expert in stocks. Luckily, I gave it to more of a financial expert because I just put money over there for my kids, 529, their UTMAs, all that kind of stuff. And he did very much like you did, like a financial advisor would, is take pretty good care of me. And at least we didn't lose it. And we always gained. And I kept adding money to it. Like a weighted average investing seems to work for me. Just makes just a very simple thing. If you just keep adding to the market, of course, your balance is going to go up unless you're in a very volatile or bad pick. So that's what worked for me. But getting back to you much more. You probably want to answer this somewhere later in our conversation, but I'm just like, why not stick to what you're so great at? But I guess we could go into kind of more my line of questioning would be, what's the difference between stocks and real estate? That's really what I want to talk about because that's what I do,
Sure.
real estate.
Sure. Having really lost a lot of money in stocks and seen some pretty violent things happen in the stock market, I've learned no matter how knowledgeable I might think I am, which, by the way, one of the biggest things I've learned is to be very humble. Like other people probably know how to analyze companies better than me, and I'll take their picks, but then I will trade them using my own rules and my own brain. I'll have the courage to trade them myself, but I'm not so proud that I won't say, hey, this is highly rated by this analyst or this publication. It looks like it's got solid math behind it, and I will buy it. But I started investing with you circa 2013 in multifamily properties. And the reason I did that is I didn't want to put all my money into the stock market. I didn't want to take that chance. I didn't think that was prudent. And by the way, that was before I started managing my mom's money. I was actually very passionate reading about real estate investments at that time, circa 2010, and I was really focused on it. And that's why I came and started hanging out with you. And we bought our first building together. You'd bought many before, but for me, I broke a rule. I took money on my home equity line of credit, and I believe I invested $40,000 or $50,000 in a 6-unit building. And when we were looking at it, it looked like we were paying maybe too much for it. It was in really bad shape. And it was modeling, it was going to make about 15% per year. And I was like, gosh, that doesn't really knock my socks off. I want to make big money here. But I think this is a prudent investment. I think Bill really knows what he's doing. I understand the investment. And so I went for it. And instead of doing 15%, I think we made 50% on that investment in 18 months or something. And that's the money I used to put my daughter through college, or at least part of it. I've invested out of necessity. It's probably pushed me to do things I really didn't want to do.
I have a similar story in the real estate aspect too. And I think that's probably about halfway through my career as a syndicator, putting together deals with other people. I wish I had you in earlier, but still glad to have you by my side now. You're a tremendous asset for the firm. What are the pros and cons? Which one do you choose or why? Or maybe you're saying it needs to be diversified, a little bit of both. What are you telling us today? Are you trying to time it? Is it 20% this one and 80% this one when it's going well? Or it sounds like both our strategies, I think, at least in real estate, is buy and hold a little bit longer. And stocks, it seems like you had that approach. So how do you put money in both? It's tough, I'm sure. But
Sure. That's one thing that I don't consider myself the best expert on either one, but I have done both. So I think I can provide a meaningful comparison between investing in real estate. And here we're talking about multifamily, but it could be something else, or doing stocks. Let's just those basic categories. And the thing about real estate is it's a tangible bricks and mortar asset that you can touch it, you can see it, you can feel it, you can inspect it, and you can evaluate the financials if you know what you're doing. Honestly, let's be real. You and I can evaluate a property in less than 20 minutes, big picture. When we underwrite it to buy it, we spend many hours, but the original analysis is quite simple. You've got operating expenses, you got rent, you got debt service, you got your cap rate and your other indicators, and you can evaluate how much you can raise rents. And pretty soon you're getting a feel for the investment. Now, I'll quote Buffett again. Warren Buffett says he won't invest in any business that he doesn't understand. So he didn't do tech stocks when they first got popular. He got a lot of criticism for that. But when they bombed in 2000, 2001, he got the last laugh. But a number of years ago, he said, okay, all these iPhones, Apple, okay, I get it. And he took a big position in Apple and he's doing well with that. But I think that real estate is really nice that most people can understand it, and it's not that incredibly difficult to get your arms around the factors that go into a good real estate investment. Heck, we all rent or own a house, one of the two. By nature, we all have a feel for it. Stocks are a totally different animal. You can you really even go visit the company in this day and age? It's very hard. You have to believe something that's on a piece of paper and hope you're not being lied to. That's why diversification is such a big thing. Because, like, you look at Enron, it was the name brand in energy. Everybody thought it was a blue chip stock, and people got really damaged personally because some people had put all their life savings into that one company. So I feel that's one thing I really like about real estate. I don't feel like that can happen to you, at least not to the same degree. That fake accounting, that makes me really nervous. Somebody can they got accountants that are really highly paid and they put out a lot of materials and who knows what's in there, right?
Yeah, we have to prove up a lot of stuff, right? Are they really paying these rents in our real estate? Are they really doing that? We get a chance to check out each kind of building that we buy is like a small company, so we have to evaluate it. Very similar, I'm sure, but we don't have these brilliant accountants with billions of dollars making these large income and balance sheet things movements that we most accountants can't even decipher. So yeah, that cooking the books is a concern. Trusting a company is a concern. You're not going to call up the president of Coca-Cola and say, "Hey, I'm a stockholder here. I want to talk." You
Yeah,
can vote. You can vote, but you're one of trillions, right? So
right.
yeah, a little out of control. But then again, you can invest in some exciting companies. From your perspective, though, I'm such a numbers guy. Sorry, you're probably more than I am, but I numbers and returns and stuff. People are investors that talk to us how to make money from a numbers perspective. What kind of return can you expect? Stocks versus real estate. Keeps going back to the same theme, but that's our theme of our talk today.
Sure. So real estate in general, of course, there's so many different, you got everything from development and severely distressed assets to the basic value add like we do, where we buy buildings that don't have major problems, but they need work. The poorly managed, rents are low, and then we improve them. So I would say real estate has a range of maybe 6% annual return for a really class AAA asset, all the way up to maybe 20% annual rate of return. Of course, nice thing about real estate, if you make a really good buy, you can occasionally do like 100% in 1 year, but I would never count on that. You plan for conservative expectations, and there was a deal we did, we modeled it at 30% annual rate of return and we achieved 100% in a little over a year, but things did go quite well. Now, meanwhile, with stocks, just looking at the S&P 500, you're talking about 10% per year, and honestly, that's over a very long period of time. That's decades and decades of market history for the S&P 500. But the catch is you have to be able to ride out some really tough ups and downs. If you put real estate and stocks on a chart, you're going to see a lot more fluctuation in the S&P 500 than you do in real estate assets. And of course, they reprice stocks every single day. So you get to watch CNBC and see how much your stock or your index fund or whatever it is went up or down. And that noise it can be unbearable. It'd almost be better if it wasn't there.
I do remember that. I don't do that much investing. When I do, to hear it or look at it every day killed me. Just looking at it
Yeah.
once a month, the statement that I got was, you know what I did, to be honest with you? The smartest thing I did is I looked at it, I saw it, and I filed it away. I didn't deal with it. I let somebody else deal with it. That was a comfort for me. It wasn't where my majority of money was, so I wasn't concerned. Plus, I knew it was in very stable situation. So I really wasn't trying to make bank. I was just trying to help the market, and I did well in it. I'm sure you did better, but it's just the volatility killed me looking at it every day. I don't think I could do it. I guess maybe I wanted too much control. I think I can do better, but I knew I couldn't. So I just let the experts handle it on that one.
Yeah. It's too easy to trade. All trading is done online now. You can click your mouse and sell something. That's really scary when you think about it. You could have been holding something for years, and one day you see a headline, you don't like it, you click sell. Now you have a taxable gain, and literally the next day, you could be saying, "Oh, I shouldn't have sold that. That was just a little blip. That wasn't a significant news." And real estate, one of the disadvantages is it's illiquid. It's hard to buy and sell it quickly, especially to sell it quickly. Once you're in, it's hard to get out. But I almost think, ironically, that's a good thing because it makes you sit and let your money work for you, which the vast majority of investments, that's really what you need to do. Another really famous investor from the 20s, early part of the last century, Jesse Livermore, said the thing that made me the most money was my sitting, being able to sit on my hands and let the market do its thing. And he says most people can't do it. And that's really what we're talking about here is investing is so much psychology in your own brain as an asset. How much can you tolerate? And you have to, that's a big lesson I learned. At first, you just think the market's got to do its thing and I have to be able to sit and wait it out no matter what. No, you have to do what you feel comfortable with.
Now you manage your own portfolio, but let's just say people like me, I'm paying a broker, stockbroker, whatever, a house, whatever, and real estate people too have to pay a transaction cost that can be quite a lot of money. Brokers' incentives are to sell. I'm a broker, I'm a real estate broker, and of course I grew up trying to sell and trade because that's what I was, a salesman, and I learned a lot from that. But now that I'm on more the investor side of things, I'm realizing that all these people that bought and held do really well. And there's from the mom and pop all the way up to the total professionals. And so I'm just wondering, how does that relate to what you're saying is what I'm saying.
Sure. Here's another interesting nugget for everyone. So I'm talking about whatever knowledge I do have, which I'm by no means a professional trader. I've just learned some things over the years that work for me. But my retirement account, my personal IRA, I have another company manage that for me because I felt like psychologically, mentally, too big of a load for me to be responsible for really what is my retirement. I'm hoping I'm going to have these other investments pay off so I can have a really nice retirement. But my basic retirement is that IRA, and I have somebody else managing that so they can take the responsibility. And I am so happy that I did that. I have never regretted taking that load off my shoulders.
Does it do as well as you on the honest curve, or is it been going longer or more money? And
Sure.
I don't know. I'm just curious how it goes. How you think?
Uh, I'll give you the honest answer. I've done better than them in short term bursts because I'll take on more risk and put a higher percentage in growth stocks, for instance. In the long run, I would say honestly, they're more consistent because they have the discipline. They put money in names that are quite boring to me, but When the market starts to get volatile or take a downswing, all of a sudden you're really happy that you have that diversification and some of those quote unquote boring names that stand up quite well.
But if I may ask this, what's riskier? It sounds like there's a lot of volatility in stocks, but also you can trade them. One of the things in real estate maybe you're going to talk about is leverage, the use of leverage, and there's not as much techniques for that, although you can margin stocks and all that. But could you talk a little bit about both leverage, but also about like the two asset classes that we're talking about here and the risk? And I know it's the gamut risk. There's been a lot of talk about risk. I remember when the market was real bad, they were talking about our government getting, was it AAA to BBB or whatever? What's that all about? If you can't trust the risk-free rate, which we learned in college in the 80s, what is it? There's a lot of things going on about paper, money, everything. I'm very concerned about it. Can you talk a little bit about, I ask a lot of questions there, but can you just talk about roughly what the asset classes and how they compare in risk and return if you're going to
Sure.
add something to that? Yeah.
You said something really interesting there about worrying about the quality of government debt and are people starting to write really bad loans, toxic loans again. And then we got a presidential election coming up. We're running huge budget deficits. We have conflicts in multiple countries. We're in competition with foreign economies, and there's trade imbalances. Oil it seems like it has a life of its own as far as that goes up and down in price. So what this really means is if you're going to invest, you can't concentrate on we call those headwinds. You can't
Mm-hmm.
worry about all those things at once. You'll never put a penny in the market. So you have to boil it down to, okay, yeah, anything could happen, but what's a real risk over the next 12 to 24 months? And with real estate, same thing. Oh, there's rent control and there's inflation and there's other renters' rights and there might be an earthquake. And you have to boil that down to, okay, yeah, but what can we control? What's the outlook for the next? With real estate, I would probably say more like 3 years, 3 to 4 years is what I'd be concerned with because it takes us about that long to raise rents where we want them to, right?
If you're
So,
buying add value properties, yes, for sure. It's very interesting you said that. So obviously real estate a little bit longer term approach. And for real estate for me, it was just like forced savings. I got some money, I put it away, and now I couldn't spend it. Literally, I honestly, I'm like most people, the shiny object, I want to buy that Ferrari, and I forgave it to keep putting money in real estate. It's done very well for me over the long haul. Anyway, just enough about me, but I'm interested in what you think about. I'm just worried about the volatility of the stock market, and I don't know it very well, so I don't play the game I don't know. And one more thing is when I play poker with a guy that has a lot more chips, and that's if I went up against a very large poker player, Paul Ivy or whatever, and I had very little money, I run a little scared because I know overall the guy's going to end up beating me because I'm going to take a chance and he's going to wipe me out. So I'm talking gambling and we're talking investing. Could you add something to that? Could you say something about gambling versus investing? I don't know if you prepared to say anything on that, but what do you
very
feel the
prepared.
differences are?
Yeah,
Okay.
that's one of my pet peeves when people call it gambling. Investing is not at all like playing poker unless you're handling millions of shares in the public realm and trying to trade them against other major houses. Then that would come into play. But for us normal average investors, there's nothing of that. And we actually do have an advantage that we could buy as many shares as we want and we won't affect the price. Somebody like Buffett has to worry, I'm going to take a position in Apple. If people find out I'm buying and the millions and millions of dollars I'm putting in, I'm going to drive the price up on myself. So us little guys, we actually have an advantage that nobody's going to see us. We can do whatever we want. But you were talking about being scared of the stock market. I think the stock market is incredibly dangerous if you're not educated because there's so much noise out there. There's so many people telling you what to do. You can turn on CNBC, which I love their tickers and their numbers on the bottom. I ignore everything they say. You can get the worst advice on that program. They're terrible investing advice. Oh, today you should be a stock picker and buying. Next Tuesday, oh, you might want to think about selling now. Just they'll bankrupt you in a second. And with stocks, you can buy obscure names and get yourself in trouble. You can trade options and murder yourself. You can buy on margin and wipe out your account very quickly. So I think real estate is, to me, it's a lot less scary. And you want to borrow on a property, a lender's going to tell you if your loan makes sense. They won't lend you the money if the property doesn't underwrite properly.
So I found out what my strategy is: slow and steady, stupid. That's perfect for
Yeah.
me. I like that. Yeah, that's perfect.
Yeah.
I like to be dumb and make money at the same time. That's really good.
Yeah, the way I did my mom's portfolio, honestly, it was not glamorous. It was so boring. I figured out that because she had a large account, there were no commissions on the trade, free trades. So she's got $1 million. I was trading $1,000 at a time. Get up on Tuesday, buy $1,000 of whatever it is. Wait 3 days. If it went up 2%, buy another $1,000. And I'd build them up until they were a maximum of $10,000. If they didn't go up at all, I wouldn't put any more money in them, and it took me a year to deploy our money. I was so exhausted at the end of the year. And then the portfolio ran itself. I just made annual adjustments, but that is not glamorous. It's, well, my favorite guy again, Jesse Livermore, he said he finally learned, yeah, you have to work for your money. You there's no taking big swings and seeing big profits just for fun like gambling. It's just not like that. You have to work hard.
Just to be honest, do-it-yourselfers. I'm going to call you a do-it-yourselfer in this department. And it takes a lot of work and a lot of time. And that was also a lot of money deployed. Not everybody has that. Like, I don't have $1.8 million just sitting to deploy right into the stock market. I have too much in real estate. But anyway, like, I like how you methodically did it. And I think that's the key to your success. I think you learned, it wasn't a mistake. You learned when you first started because you got burnt. And now you say,
Yep.
I'm not going to do this again. But you also had, just to be honest, you also had a little bit of a war chest in money, $1 million, where most of us don't start with that. But it's, you got to be patient, right? And I often try to dissuade people from being a do-it-yourselfer in real estate because it's so more management intensive. But I guess you could do more stock investing by yourself because it's a little bit more informative, and there's still a lot of analysis, a lot of work, as you can see, and discipline. But I don't have the education background in the stock market. I do in real estate because I've been at 40 years. For me, real estate do-it-yourselfer, I've never found a harder time to do it. There's just too many things going on with everything: liability, fixing things, cost of things, estimates, all the things we have to do. And just do it yourselfers. There's a lot. I encourage people to, if they can do it themselves, fine, but you're taking on a lot of risk and a lot of jobs. And if you have another job, it's hard to do it as a second job.
Sure. Good,
So
good,
I was just
good
thinking
point.
that.
Yeah, I think being a do-it-yourselfer in stocks, it's so easy. You can open an account in 5 minutes, fund it with $5,000 or something, and you're trading right then, which is actually terrifying because you don't have to have any qualifications to do that. You could get rid of your $5,000 in a hurry. And I said I learned to be not be too proud to take analysis from other people, reputable publications, whatever you read, the Motley Fool, articles on Yahoo Finance, the Wall Street Journal, Goldman Sachs buy list. There's reputable sources out there. There's articles in Forbes. There's a million of them, and you find those, then you can find good investments for yourself. But with real estate, I would say the same thing. Don't be so proud. Find a good broker that you can really trust, and they'll help. A good broker will put you in touch with good buying opportunities and something that's a good fit for you. Then find a reputable property manager, let them manage for you. But what are we doing now? We're doing homework. We got to interview 3 brokers. We got to interview 3 property managers. We got to network with people and get references. So we end up working for our money anyway. Or I'm sure you're eager to say that you could just use a syndicator like us, and they do everything.
Yeah, we're not the one-stop shop for everybody. If we're holding a building long-term and somebody wants to make quick money, we not may not be for them. But maybe our assets, we have a short lifespan of 3 to 5 years. But some of our real keeper properties are 10 years plus, so they may just choose not to invest in that. I compare sports a lot, like the owner of the Dodgers, and then the manager of the Dodgers, and then the pitcher, and then all that kind of stuff. stuff. And you can play any part you want. You can be out there trying to hit the ball. But I find it's very hard to do all those positions and have the perspective. And you can always, if you're hiring somebody, yeah, there's a little work to interview them, but you can always change the batter, right? You can always change your property manager. You can even change your real estate broker. You can change your loan broker or your bank. It's hard to change the building that you buy because real estate's a little bit more permanent. If you buy and it goes down, I guess I compare it to a stock. Just because the value of the stock goes down, you shouldn't panic because you're not looking to sell it today. But if you're reminded every day on the ticker tape and you're watching it every day, I don't look at the value of my property every day. I'd go nuts. So for me, I like the slow play of real estate, but I'm an active person. I'm a trader in real estate, and I've done lots of flips to get more money on more money to create my returns, to
Sure.
get money to grow. And that may be a solution for stocks, but I'm just certainly not an expert and well versed in that. But historically, in the time periods of stocks, I know real estate well. It's like decade to decade. I know it's followed, it's slower, so it's easier to predict. I really like that, by the way. I think real estate's much easier to predict than the stock market.
Oh, yeah.
And an individual building is one company, I call it. But what's going on with the asset? What's going on with historically with stocks? Maybe I know you can't talk about every single year or decade, or can you talk about some patterns? Or I think you already did a little bit about certain crises that happened, but can you give us a little?
Sure.
Is it right now a good time to buy stock?
Sure.
Right? Everyone asks me, is it a good time to buy real estate? I know my answer on real estate. What's your answer? Is it a good time to buy stock right now? And
It's
what pick do I need, Duane?
Yeah, it's always a good time to buy good stocks. It's always a good time to buy good real estate. And this is again from Jesse Livermore. His book, Reminiscences, I can't say that word right. Reminiscences of a Stock Operator is just been an inspiration for my life, really. That guy was so brilliant.
So many people quote that Robert Kiyosaki, which turned me on, and I can't believe how many younger people have just been so inspired by that book about get out of the rat race, start in taking care of yourself, and get better educated in financial education. Sounds like you've done a lot, and I know you've done a lot of reading. You've told me how many business books you read. It's incredible.
Found out all these people that made a lot of money, I found out they're avid readers and they always have certain books that inspired them. We can learn. That's why we study history. I lost my train of thought and now I
mm,
remember
mm.
what was the thing he was oh yeah, he said, so here's the stock tip you need. It's a bull market. That's it. That is the stock tip you need. That's the advice you need. If it's a bull market, you should be buying. Right now we're in a bull market. So there's my stock picking advice. And then
I'm such a contrarian to that. Because in real estate, when everyone's selling, it's like it's hard to be a buyer. I get bid out, that people pay too much. I encourage my clients not to buy it. I've almost lost clients. I almost lost a client last month selling a home. Selling a
yeah,
home. I really want to buy this home. I said, why? It's overpriced. I just really want to buy this home. Don't argue with me. I'm like, you know, do you really want to pay more than you need to? Yes, I want the home. Client's always right. Done. Right.
yeah,
So
we're value investors in real estate. That's what we do is value investing. And in
yeah.
my personal opinion, you could do value investing in stocks. There's a host of people that make their whole living. To me, it's in this day and age, it's hard to find value stocks because to find stocks that are underpriced, there's so much research and so many people watching them that I don't see a lot of stuff that's grossly mispriced. And that's a challenge. But you were asking about going over the years. There's a few years we did it in one of our marketing pieces. We did a study. We put on a bar chart, average multifamily returns. It's for the whole United States, not our stuff. And then we compared it to the S&P 500. And every year, it seems like whatever stocks are doing, multifamily is a little bit less. There were some particular recent years, 2011, 2015, 2022. Stocks were either flat or in 22 big losses, and multifamily was exactly the opposite. It was gaining. So if you were to own some of both, that means you always have something that's going up for you. And I swear that's a good feeling to have. That's good for you psychologically. I think that's good diversification. But there is another point that we totally didn't touch on that is very important. So we should talk about taxes,
Yes,
right?
absolutely.
Yeah.
Absolutely.
Real estate has a ton of tax advantages, and stocks, really very few. The only thing that if you hold it more than a year, then it's long term capital gains. But if you're wealthy, your capital gains tax rate could be as high as 20%. And if you decide to flip a stock and sell it in less than a year, then it's that gain is taxed as ordinary income. Now, with real estate, we can write off mortgage interest, we can write off depreciation. And a lot of times, our properties have, at least on paper, have losses when we first buy them because they need a lot of work. So we end up, whatever cash flow we're distributing, or if you own the property yourself, whatever money you're taking out of it, often you could be taking money out of it. And yet, as far as tax reporting is concerned, you're not paying any taxes on it. And that is something really attractive about real estate. One other thing is, I think, pride of ownership. I drive by one of our buildings that we syndicated, and I own a percentage of that, and I get to drive by it every morning. That's something I can't do with stocks. That means a lot to me.
Okay, and you're owning a part of it, right? So it's not just your building, right? But you still you own part of it. You're an owner, right? So you feel
Hey,
entitled. Yeah.
I wish I owned the whole thing, but I'm definitely proud of my piece. And in a way, hey, look at it. You don't want to own the whole building. You want to own a small piece of it, more diversification, right?
You could buy many deals, which actually last time we talked, you said you had 8, 10 positions. I'm like, wow, I didn't even know that you did all that. So that's cool. You move fast and very secretive.
Yeah.
I didn't know
You
that.
well, you kept trading them, Bill. You kept 1031 exchanging them. So I'd buy one building and it end up owning in succession like three of them, and then one time you traded it and you sold one building and bought two others. So all of a sudden I thought I had one baby and I had two babies. I was like, wow, that's crazy.
As long as you don't have to feed them, that's the key. As long as they're paying you back. But hey, do you have anything else to inquire or talk about, or something I left out, or something that is just imparting, like what something to leave with people? Because it sounds like if
Sure.
you buy both and have a foot in both, which I didn't do,
Yeah.
and I learned because some years I didn't do well in real estate for a year or two, waiting it out when I could have been taking advantage, but I just didn't know who to trust and what to do. Tell me a little bit about that. What do you think?
I think my parting word would be, because that's the problem with this investments. There's so much information, you feel overwhelmed at the end, and you say, I don't know. I don't we see that all the time with people. They're just like, oh, I just don't know what to do. And so then they don't do anything. So I would say diversification over and over again, spread your money around and try and network yourself with reputable people. If you're doing real estate, you can actually make in person touches. In the world of stocks, probably a little bit more like publications and books and stuff, but take all that advice and information, distill it down to what works for you, and then move slowly. And hey, you'll get rich slow. That you say, oh, I want to double my money in a year. Yeah, but try making 20% on your money in a year and see how good you feel at the end of that year. It's a lot better than you think. So that's my take.
That's awesome, Duane. Hey, I just want to let you know, like, we're no financial advisor giving tax and investment information. It's a discussion, but we've both done a lot of experience in it. And it sounds like you can be in both, which is great because I had a notion that you did, and I did a little bit, but I didn't really take advantage of that. And get a mentor, right? Get a broker, read books, research sounds good. But you also had a lot of strategies that you employed. You were disciplined and you played the long game. And it sounds like you're actually doing both in both avenues. And if anybody wants to reach us about just some more information, or if we said something or two that struck something good in you that you really want to talk about some more, you can reach us on our website at trwealthmanagement.com. And in there, we have a calendar to book some time to talk about things on both investments and the timing and what you want to do with your investment money, whether it's you're starting out and trying to figure it out, whether you're in midstream and got kids in college like I do, or you're older and have some money and you really want to earn more money on it. We do real estate investing for that. For stocks, it would be more just personal, Duane telling you what's worked for him and some good knowledge, and maybe even some books and periodicals he has, because He's got a wealth of information and real knowledge. Give us a call anytime or look us up on our website. Follow us on social media. And we thank you, and I hope to hear back from you. And Duane, thank you so much for this tutorial. I need a lot of learning to go.
Thanks, Bill. I really enjoyed this.
All right, Duane, take it easy.